Exercise 20 on page 111. We're asked to analyze these T accounts to figure out what is an explanation for what took place based on the T account. This is not something that companies are going to need to do. Companies are going to have source documents that tell them what transaction has taken place so they then can record the transaction as it happens. The point of this exercise is to make sure you truly understand the transaction process forward and backwards. It's sometimes easy to memorize transactions and memorize that if we receive cash for services, then we debit cash and we credit the revenue. But it's not always easy to look at it from the backside forward. So if we look at this backwards, then you have a better understanding and know exactly what you do know versus what you're unsure of. So when we're looking at debits and credits, total debits must always equal total credits. So we have to always have at least one debit and one credit. So when we're looking at trying to analyze these transactions, we always need to look for a debit and a credit for each transaction. So the first one, we look for a debit for transaction 1. And if we look, we see cash for $370,000. Debits on the left, credits on the right, always. So we have a debit to cash for $370,000. And we have a credit to common stock for $370,000. So that is our debit, then that is our credit. Cash is a debit, common stock is a credit. So what we're looking at is we're increasing our cash as we increase common stock. So we received cash because of issuing common stock. The second one, when we look, we see a debit to building. Building has $360,000 on the left. So we need to look for a total credit of $360,000, and we find that with cash. Cash has $360,000 as a credit. The building is an asset. As an asset, the asset is going to increase as a debit. The cash is also an asset. As an asset with a credit, we are actually looking at the cash asset is going down. So the cash is going down because we have purchased this building. So we paid $360,000 cash to buy a building. Transaction 3, we see a debit to cash for $260,000 on the left. So we need $260,000 on the right, and we find that with notes payable. Notes payable is where you go to a financial institution and sign a note saying you're going to pay some amount in the future. Anytime you have a payable, it is a liability. So cash is a debit. As a debit, it's going to increase. So notes payable is a liability. As a credit, it is increasing. So we're increasing our liability as we increase our cash. So we're borrowing $260,000 and we're going to have to pay that back at a later date. So we signed a note payable and create the liability. Transaction 4. The debit amount is going to be office supplies because office supplies is on the left. And we look to the right and we see accounts payable. Both of them are $1,500. So we know we increase the office supplies because office supplies are an asset. Assets increases a debit. And we know that accounts payable is a liability. As a liability, accounts payable is going to increase as a credit. So we are paying, we are purchasing the office supplies, but we're not paying cash because cash did not go down. The actual account is accounts payable. It was a liability going up. 5, we look for a debit to 5 and we find accounts payable for $1,200. And a credit for transaction 5 is to cash. So we know that we're paying cash. The reason we're paying cash is on account. We just purchased $1,500 of office supplies on account, and now we're paying $1,200. We didn't pay the full amount, so we can only record the transaction for what actually was paid. So we're looking at $1,200 was paid, so cash is going to go down as accounts payable goes down as well. We no longer owe $1,500, we only owe $1,200. 6, we see that on the left for the debit we have property tax expense, and on the right we have cash for $1,500. So we are looking at a property tax expense is going up because an expense goes up as a debit, cash goes down as a credit, so we're paying cash for $1,500 of property tax expense. 7, our debit is going to be rent expense because we have a rent expense on the left. When we look for 7 on the right, we see cash, but the rent expense is $1,400, and the cash for transaction 7 is $3,900. So that tells us we have paid 2 things in cash. So we have to look again, and we see salaries expense is $2,500. So not only did we pay for rent in cash, we also paid for our salaries expense. So cash went down, total of $3,900, and rent and salaries, actually the expense went up as a debit. 8, we see a debit to dividends because it's on the left, and we see a credit to cash on the right. Dividends are going to increase as a debit. Cash is going to decrease as a credit. So we're increasing dividends as we pay out cash. So we are paying out cash dividends to our stockholders for $7,000. 9, we're looking at a debit for transaction 9 is cash for $21,000 and a credit to service revenue for $21,000. So cash is going up, so we know we're receiving cash. The reason we're receiving cash is because we have performed some services. When we perform the services, we're going to account for service revenue of $21,000. So for this transaction, we worked our way backwards from T accounts back to the transaction. Realistically, the process would be to know the transaction, record the transaction as a journal entry where we include the debit first and then the credit. And after we record that, then we would take the information from our journal entry and post it to the general ledger. The general ledger T accounts is what we would be posting as found on page 111.